Tomorrow is April the 15th, 2026. Tax Day, the single most important annual financial date in the United States. The day when 164 million American taxpayers are legally required to settle their accounts with the federal government. The day when hundreds of billions of dollars flow out of bank accounts, out of checking accounts, out of savings accounts, out of business cash reserves, and move in a single massive wave directly into the United States Treasury. And here is what almost nobody who is filing their taxes tomorrow understands about what that payment is actually doing to the American financial system in real time. Every dollar you send to the IRS tomorrow does not just leave your account, it leaves the entire banking system. Completely, permanently, until the government chooses to spend it back out. When you pay your taxes, your bank settles that payment by moving an equal amount of money from its reserve balance at the Federal Reserve directly into the Treasury's account at the Federal Reserve. That account is called the Treasury General Account. And every single dollar that flows into that account on and around April the 15th is a dollar that is no longer available to the banking system to lend, to fund overnight operations, to support the repo market, or to maintain the liquidity that keeps financial markets functioning smoothly. A $1 increase in the Treasury General Account equals a $1 decrease in bank reserves. Dollar for dollar, no exceptions, no cushion, no lag. The Federal Reserve Bank of New York confirmed in a speech delivered just 3 weeks ago, on March the 26th of this year, that the Treasury General Account is expected to temporarily peak at approximately $1,025 billion, give or take $50 billion, by late April of 2026. That is an increase of approximately $185 billion from the $840 billion balance that existed on March the 25th. $185 billion being pulled out of the banking system in the space of 3 to 4 weeks. And that is the conservative estimate. The actual April tax surge could push the number higher. By the end of this, you're going to understand exactly what the April 15th shock is, where it comes from, and why the specific conditions of this particular April make it more dangerous than most. You are going to understand the plumbing mechanism that makes tax season a liquidity event, not just a personal finance event. You're going to understand what happened the last time this mechanism was stressed to its limits, why the Federal Reserve is already responding to prevent a repeat, and what it means for stocks, for credit, and for the financial system, that the $120 per barrel oil shock, the Iran war, and the Treasury drain are all arriving at the same moment. And you are going to understand the second layer of this story, the part that nobody in the mainstream financial media is connecting. Because this April, something is different about the IRS itself. And that difference changes the equation in ways that reach far beyond a single tax deadline. Let us start with the mechanism. Because most people have no mental model for what actually happens inside the financial system when taxes are paid. And without that model, none of the rest of this analysis makes sense. Think of the American financial system as a network of interconnected pools of water. The biggest pool is bank reserves. This is the money that commercial banks hold at the Federal Reserve. It is the foundational liquidity of the entire system. Every bank loan, every overnight funding transaction, every repo agreement, every credit facility that flows through Wall Street traces back ultimately to the availability of these reserves. When reserves are abundant, credit flows freely. Interest rates in the overnight funding market stay calm. Banks can lend to each other, to businesses, to consumers without friction. When reserves become scarce, funding costs rise. Credit tightens. Markets feel the squeeze even before any official policy change is made. The Treasury General Account is a different pool. It sits at the Federal Reserve, but it is not part of the banking system in the sense that banks can use it. It is the government's checking account. When money sits in the Treasury General Account, it is completely outside the financial system from the perspective of private banks. It cannot be lent. It cannot be used as collateral. It cannot fund overnight operations. It just sits there, waiting to be spent out through government payments. Here is why this matters so acutely right now. The Federal Reserve's own research and the Federal Reserve Bank of New York speech from late March confirmed that bank reserves currently stand at a level that provides only a modest cushion, above what Federal Reserve Governor Christopher Waller has described as the danger threshold. Governor Waller's guidance is that reserves below 8% of GDP, which is approximately $2,700 billion in today's economy, could be problematic for market functioning. The current reserve level, heading into April 15th, was approximately $2,890 billion according to the November 2025 data, with modest changes since. That is a cushion of just $190 billion above the danger threshold. The Treasury is about to pull approximately $185 billion out of that cushion in 3 to 4 weeks. Do you see the problem? The Federal Reserve Bank of New York saw it too. That is precisely why the New York Fed began conducting what it calls reserve management purchases in late March of this year. buying $40 billion per month in Treasury securities, specifically to inject reserves back into the banking system and prevent April tax flows from pushing reserves below the ample range. The speech from March the 26th was explicit about this. Without action, there was a high likelihood that those flows would have pushed reserves below the ample range in April, potentially creating challenges for effective rate control. That is not an analyst's speculation. That is the Federal Reserve Bank of New York describing its own emergency response to the April 15th dynamic in the clearest language it could use without triggering a market panic. Let us talk about what happens when reserves fall below the ample range. Because it has happened before, and the consequences were not theoretical. In September of 2019, bank reserves fell below what the market needed to function smoothly. The overnight repo market, which is the short-term funding market where banks and financial institutions borrow from each other to fund daily operations, seized up almost overnight. Overnight repo rates spiked above 10% in a single day. 10%. For context, the Federal Reserve's policy rate at the time was targeting a range of around 2%. A repo rate 10 times higher than policy guidance is not a signal of market stress. It is a signal of market breakdown. The Federal Reserve was forced to inject enormous emergency liquidity into the repo market immediately and had to continue doing so for months. The cause was not a financial crisis in the traditional sense. There was no bank failure. There was no housing market collapse. The cause was simply that the amount of bank reserves fell below the level needed to support smooth functioning of overnight funding markets. The plumbing broke because the pool ran dry. The September 2019 episode is the specific historical precedent that every Federal Reserve official and every bank liquidity professional is thinking about right now as April the 15th approaches. Because the specific conditions that created that episode, a combination of Treasury general account buildup from tax receipts and insufficient reserve levels in the banking system, are present again in April 2026. The Fed is trying to prevent a repeat by buying $40 billion a month in Treasuries, but the gap between where reserves are and where they need to be is narrow enough that the math is tight. And here's what makes this April different from every other April in recent memory. Two converging shocks are hitting the liquidity system simultaneously. The first shock is the tax season drain that happens every year. The second shock is the oil price environment created by the Iran war that is actively compressing economic activity, pushing inflation expectations higher, and creating the specific combination of conditions that the Federal Reserve finds most difficult to manage. Oil at $115.42 per barrel as of April the 10th, and rising after yesterday's blockade announcement, is not just an energy story, it is a banking system story. Here is why. High oil prices are inflationary. Inflation expectations rising cause bond investors to demand higher yields on Treasury securities to compensate for the inflation risk. Higher Treasury yields mean lower Treasury prices. And commercial banks are sitting on enormous portfolios of Treasury securities that they purchased during the low-rate era of 2020 and 2021. When Treasury yields rise, those portfolios lose market value. And when those portfolios lose market value, the effective capital position of every bank holding them deteriorates. This is the exact mechanism that destroyed Silicon Valley Bank in 2023. Silicon Valley Bank held a large portfolio of long-duration Treasury securities that it had purchased when rates were low. And when rates rose rapidly in 2022 and 2023, those securities lost market value. When depositors became aware of the problem and began withdrawing funds, the bank could not sell the securities at par to meet the withdrawals without crystallizing the losses. The bank failed in 48 hours. The Silicon Valley Bank collapse is the most recent demonstration of what happens when the specific combination of rising yields, deteriorating bank portfolio values, and liquidity pressure occur simultaneously. In April of 2026, with oil spiking, with inflation expectations elevated by the Iran war's energy shock, with the Federal Reserve holding the policy rate at 4.5%, and with the Treasury general account expected to peak at $1.025 trillion, the conditions for Treasury yield pressure and reserve scarcity are both present at the same time. The Federal Reserve Bank of New York's $30 trillion Treasury market is the largest securities market in the world. And the liquidity in that market, measured by how easily bonds can be bought and sold without moving prices significantly, has been under periodic stress. The New York Fed's Liberty Street Economics published an analysis on April 7th of this year, documenting that Treasury market liquidity has been volatile over the past year, with sharp deteriorations in liquidity coinciding with periods of market stress. The April tax drain is one of the identified periods of high payment flows that create tighter balance sheet constraints and reduce dealer capacity to intermediate the Treasury market. Now let us bring in the second layer of this story, because the April 15th shock is not just a plumbing story about bank reserves and Treasury accounts. It is also a story about what is happening to the institution that collects the taxes in the first place. And this part of the story is one of the most consequential and least understood developments in American fiscal history. In February of 2026, DOGE, the Department of Government Efficiency, led by Elon Musk, terminated approximately 6,000 to 7,000 IRS employees. These were primarily probationary workers, meaning they had been with the agency less than 2 years. Many were in taxpayer services. A significant portion were in compliance, the division that audits returns and pursues discrepancies, and some were in information technology, the people who keep the IRS's systems running during the most intensive processing period of the year. To put this in perspective, the IRS entered 2026 with approximately 90,000 employees. Losing 7,000 is an 8% cut. But it is not a normal 8% cut from a normal agency at a normal time. It is an 8% cut from the agency processing the largest volume of returns in its history during the single 8-week period when the entire annual revenue collection of the United States federal government is concentrated. The IRS was simultaneously beginning a record filing season, expecting 164 million individual returns and losing nearly 1 in every 12 employees who had been handling that workload. The IRS's own union, the National Treasury Employees Union, responded with direct alarm. The union president, Doreen Greenwald, said at a press briefing earlier this month that it should send a red flag for everybody about what the status of this filing season is. She was specifically referring to the fact that the IRS had reassigned approximately 1,500 human resources and information technology workers to process returns, but that those reassigned workers are required to complete a 12-week training program for their new positions, and that training does not end until after April the 15th. The people processing your returns this April are in some cases workers who trained for 12 weeks for a job they would not normally do. Bloomberg Tax's reporting confirmed that backlogs and job holes are already visible across the IRS in the weeks before the deadline. The agency reassigned staff and pulled workers from other functions to cover the volume, but the math of the staffing reduction is difficult to paper over completely. The impact, according to multiple expert assessments, will become more obvious in the summer when the IRS shifts to correcting returns with errors and processing returns filed under the October extension deadline. But the seeds of that summer problem are being planted right now during the peak of the filing season. Here is why this matters for the $3 trillion figure in the title of this analysis. In fiscal year 2024, the IRS collected more than $5.1 trillion in gross tax collections. Individual income taxes represent the single largest component of that collection, approximately $2.4 trillion. The April 15th deadline is when the balance due payments from the people who owe money are collected, layered on top of the withholding that has been collected throughout the year. The specific balance of tax receipts versus refunds in the weeks around April the 15th is what determines how much net cash flows into the Treasury General account during the peak tax season period. As of March the 20th of this year, the IRS had already issued more than $202 billion in refunds, with the average refund reaching $3,571, up 10.9% from the same period last year. That refund increase reflects the One Big Beautiful Bill Act tax cuts that took effect for the 2025 tax year. More generous tax cuts mean larger average refunds, and larger average refunds mean that the net inflow to the Treasury General account from the April 15th tax season is partially offset by the refund outflows that precede and follow the deadline. But the balance payments due on April the 15th itself, the payments from high earners, from business owners, from investors who realized capital gains in 2025, represent a concentrated inflow that can reach hundreds of billions of dollars in a single day. The non-withheld tax collections, which is the technical category for the balance due payments on April the 15th, came in approximately $50 billion higher in April 2025 than in April 2024, according to Penn Wharton budget model research. If a similar year-over-year increase applies to 2026, driven by continued economic activity, capital gains realizations, and business income, the April 15th inflow could be even larger than the markets are currently pricing. Every extra dollar in that April 15th inflow is another dollar pulled from bank reserves into the Treasury General account. Now, here is the specific market consequence that makes all of this relevant to anyone who owns stocks, bonds, or any risk asset. When the Treasury General account rises sharply, the reduction in bank reserves creates a liquidity tightening effect that operates independently of the Federal Reserve's official policy decisions. The Federal Reserve can keep the policy rate at 4.5% unchanged, and the financial system can simultaneously experience a tightening of effective liquidity conditions because the banking system has fewer reserves available to fund overnight operations and market-making activities. This tightening manifests first in the overnight repo market. When reserves become scarce, the banks and financial institutions that need to fund their balance sheets overnight compete for a smaller pool of available cash, The competition drives overnight funding rates higher. When overnight funding rates rise, the cost of leveraged positions in every financial market rises with them. Leveraged hedge funds, which hold large positions in stocks and bonds using borrowed money, face higher financing costs on those positions. When financing costs rise, the expected return on leveraged positions falls. When the expected return falls below the cost of carry, positions get sold. And when large leveraged positions get sold, the prices of those assets fall. The connection between TGA spikes and stock market corrections is not a conspiracy theory. It is a documented empirical relationship. Every major episode of the Treasury General Account growing rapidly has been associated with either financial market stress or downward pressure on risk asset prices. In 2023, when the Treasury rebuilt the TGA by $600 billion, and approximately 3 months after the debt ceiling resolution, reserves fell sharply. Repo markets tightened and risk assets came under pressure. The Federal Reserve was forced to use its standing repo facility, the emergency lending tool it created precisely to prevent repo market breakdowns, at increasing frequency. The Federal Reserve halted its quantitative tightening program, the program of reducing its balance sheet by selling Treasury securities, effective December the 1st of 2025. The Federal Reserve Bank of New York's March 26th speech said explicitly that without the reserve management purchases, it started in late March. There was a high likelihood that April tax flows would have pushed reserves below the ample range. The Fed is fighting this problem actively and openly. It just is not doing so in the language that most people who file their taxes understand or notice. And now pile the oil price shock on top of this. Oil at $115 per barrel, rising toward the Federal Reserve Bank of Dallas's projection of $132 per barrel if the supply disruption lasts 2 quarters, is hitting the American economy at the precise moment when the banking system's liquidity cushion is at its thinnest of the entire year. High oil prices compress corporate profit margins. They reduce consumer purchasing power. They increase input costs for every industry that uses energy, which is every industry. And they do all of this at a time when the Federal Reserve cannot easily cut rates to cushion the economic blow, because cutting rates, when oil prices are driving inflation higher, would simply pour fuel onto the inflationary fire. This is the specific combination that the Federal Reserve fears most. Inflation pressures that prevent rate cuts, economic growth pressures that demand rate cuts, and a liquidity drain from the April tax season that is tightening effective financial conditions regardless of what the policy rate is. All three are present simultaneously on April the 15th of 2026. Let us talk about what this means for ordinary Americans and for their money. The first and most immediate consequence is the credit market. When bank reserves fall toward the danger threshold and overnight funding costs rise, the tightening in credit conditions is felt across every kind of borrowing. Mortgage rates, which are already elevated because of the Federal Reserve's 4.5% policy rate, face additional upward pressure when funding costs in the wholesale markets rise. Business lending rates tighten. The credit card rates that carry the debt of the 43% of American households who carry a monthly balance rise with the overnight funding market. The cost of carrying any form of debt in the American financial system rises when the Treasury pulls $3 trillion worth of annual tax revenue through the banking system in the weeks surrounding April of the 15th. The second consequence is the stock market. The S&P 500 is already carrying elevated volatility from the Iran war, the oil shock, and the uncertainty about whether the Hormuz blockade announced yesterday will escalate into a direct military confrontation between American naval forces and the IRGC. Into that environment, the April liquidity drain adds a mechanical downward pressure on risk assets that has nothing to do with corporate earnings, nothing to do with growth expectations, and nothing to do with investor sentiment. It is purely a plumbing effect. Less liquidity in the system means less money available to fund risk positions. Less money available to fund risk positions means selling pressure on assets that were being held with borrowed money. The third consequence is what happens to Treasury yields. Here's a specific irony that makes April 15th particularly complex in 2026. The same tax receipts that drain reserves from the banking system and tighten private market liquidity will eventually be spent back out by the government as it pays military personnel, defense contractors, Social Security recipients, Medicare claims, interest on the national debt, and every other government obligation. But there's a lag between the inflow on April of the 15th and the outflow through government spending. During that lag period, the Treasury General Account sits at its peak level, reserves are at their trough, and the financial system absorbs the full force of the liquidity drain. The Federal Reserve Bank of New York acknowledged this cycle explicitly in its March 26th speech. Beyond April, the TGA is likely to decline, as the Treasury uses the funds it receives via tax inflows to pay its obligations. All else equal, the decline in the TGA will result in a corresponding increase in reserves. So the drain is temporary. The reserves come back. But during the lag period, typically April through June, The financial system operates with less liquidity than at any other point of the year. And the specific timing of April 2026, when a naval blockade in the Strait of Hormuz, an oil price surge, an IRS staffing crisis, and the annual tax drain are all occurring simultaneously, means the lag period is arriving with more concurrent stresses than typical. Now, let us bring in the one element of this story that gives the picture its most unusual and potentially most consequential dimension. The DOGE cuts to the IRS that we discussed are not just a service quality problem, they are a revenue collection problem. And the revenue collection problem has a specific financial system implication that most analysts have not yet connected. The Center for American Progress published analysis in May of 2025, estimating that the combined impact of DOGE staffing cuts to the IRS, if they continue at the pace initially proposed, could cost the United States nearly $1 trillion net in lost revenue over the next decade. $1 trillion. The mechanism is simple. Fewer auditors means less audit coverage. Less audit coverage means more undetected tax non-compliance. More undetected tax non-compliance means lower actual tax collections. And, as an IRS compliance official put it directly in CNN's reporting from 2025, if we are not auditing much, it impacts people's willingness to file honestly in the first place. Every dollar of tax revenue that is not collected, because the IRS lacks the staff to enforce compliance, is a dollar that does not flow into the Treasury General account. It is a dollar that reduces the government's fiscal position. It is a dollar that adds to the deficit. And it is a dollar that the Treasury will eventually have to borrow instead, adding to the $37 trillion in outstanding national debt that is already being serviced at rates that the Federal Reserve estimates will cost $64 billion per year in interest payments by 2027. The DOGE cuts are therefore not just a story about taxpayer service quality or about whether you get your refund in 21 days or 35 days. They are a story about the long-term revenue base of the United States government. And a weakened revenue base means more borrowing. And more borrowing means more Treasury issuance. And more Treasury issuance means more supply in the bond market. And more supply in the bond market means upward pressure on yields. And upward pressure on yields means higher borrowing costs for every mortgage, every car loan, every business credit line, and every consumer debt in the United States.